As of the market close on July 29, 2026, the stock market is currently closed, and ARM Holdings plc, trading under ticker symbol ARM, closed at exactly $224.89 per share. This reflected an intraday price decline of $19.85, or a negative 8.11% move on the session, following a previous trading session close of $244.74. In extended after-hours trading, shares experienced further downward volatility, trading near the $210 range as market participants digested broader sector trends and positioned ahead of upcoming corporate reporting. While retail investor forums and popular online financial news outlets continue to frame ARM Holdings as an unstoppable titan floating on the rising tide of global artificial intelligence hardware demand, the underlying reality taking shape across institutional order books presents a far more complex picture. Most individual investors checking their accounts across popular investing sites see ARM as a clean, high-margin way to capture growth in modern computing architecture. Yet beneath the surface of this premium valuation lies a noticeable gap between public narrative expectations and the actual royalty monetization curve that drives the company's long-term earnings model. The prevailing market belief suggests that every major microchip creator, from mobile smartphone designers to cloud server builders, has no choice but to rely on ARM intellectual property to build power-efficient processors. Investors building portfolios through an individual brokerage or placing trades through a Fidelity brokerage account often group ARM alongside NVIDIA stock as a mandatory gatekeeper for advanced tech infrastructure. However, a rigorous examination of recent capital flows reveals that sophisticated institutions are taking a more measured stance. Asset managers are actively debating whether ARM can maintain its accelerated rate of royalty price increases without facing pushback from massive hardware manufacturers who are simultaneously dealing with slowing consumer upgrade cycles. To understand where the stock stands today, we have to look closely at its recent trading behavior, daily volume shifts, and sector dynamics. Over the past month, ARM has seen a distinct pullback from its mid-summer peaks, where shares traded above $350. Heavy selling volume on downward trading days indicates that institutional funds have been trimming positions to reallocate capital into lower valuation tech names or defensive cash buffers. For traders monitoring price charts on the Robinhood app or utilizing interactive brokers' trading tools, the sharp increase in options volatility reflects growing uncertainty about whether near-term earnings results can justify a trailing price-to-earnings ratio that remains elevated relative to the broader semiconductor group. When macroeconomic headwinds like persistent borrowing costs and corporate budget tightening impact tech hardware spending, high multiple growth equities bear the brunt of market repricing. When investors compare the recent chart path of ARM against consumer tech anchors like Apple stock or electric mobility leaders like Tesla stock, it becomes obvious that valuation multiple compression happens swiftly whenever revenue guidance shifts from extraordinary back to merely good. The recent pullback in ARM shares is a textbook case of short-term reality realigning with inflated market expectations. Many retail investors looking for online investment opportunities or seeking general investment help often assume that strong brand awareness and widespread market adoption automatically make a stock a safe purchase at any price. When navigating platforms like SoFi Invest or setting up automated strategies through Schwab Intelligent Portfolios, self-directed investors sometimes overlook the critical difference between a company's product quality and its equity valuation. Self-investing requires looking beyond simple headlines to analyze how much future growth is already baked into today's stock price. Whether you are managing assets inside Fidelity IRAs, leveraging the Fidelity mobile app for fast trade execution, or exploring options on the Robinhood trading platform, understanding the mechanics of institutional positioning is crucial. Large hedge funds and asset managers using interactive brokers' fee structures designed for high-frequency trading often exploit the sentiment swings between optimism and concern. When market expectation gets too far ahead of near-term cash flow, institutional distribution quietly begins, leaving retail traders wondering why a great business is seeing its stock price decline. For those engaging in online investing across various brokerage accounts, from SoFi Active Investing to standard individual brokerage setups, comparing platform tools can provide useful context on how different investor segments are reacting. Users operating on the SoFi trading platform or checking market sentiment on Robinhood stock trading features have noted a split between retail buy-the-dip activity and institutional selling. Those managing portfolios via Fidelity Wealth Management Services or allocating capital into Fidelity ETFs and Fidelity mutual funds tend to focus more on risk-adjusted equity exposure, leading to portfolio rebalancing during periods of high market volatility. Comment below how many shares of ARM Holdings plc you currently hold in your portfolio and whether you are buying this recent dip or waiting for lower price levels before taking a position. To put the recent stock movement into proper perspective, it helps to review how ARM Holdings operates as a business. Unlike traditional chip manufacturers that invest billions in building physical fabrication facilities, ARM operates purely on an intellectual property licensing model. They design CPU architectures, system blueprints, and development software tools, licensing these designs to semiconductor firms, cloud service providers, and consumer device makers. When a partner licenses an ARM design, ARM collects an upfront licensing fee. Once those chips enter mass production, ARM earns an ongoing royalty fee on every single unit sold worldwide. The company's primary growth catalyst in recent years has been the transition from older architecture generations to the newer architecture version, which yields significantly higher royalty rates per chip. By offering higher performance along with advanced security and specialized capabilities for running machine learning workloads directly on consumer devices, ARM successfully increased its monetization rate across smartphones, personal computers, and server data centers. This business model shift allowed the company to deliver expanding operating margins and robust free cash flow, driving the massive stock rally that captured Wall Street's attention following its public listing. However, historical performance and past success do not protect a stock from cyclical realities. The smartphone market, which historically provided the vast majority of ARM's royalty volume, has reached global saturation with longer replacement cycles among consumers. While ARM has made notable progress expanding into server processors and automotive computing, these end markets involve longer qualification cycles and intense competition. Furthermore, open-source chip architectures continue to gain attention among major technology companies seeking to reduce royalty expenses over the long run, presenting a structural factor that long-term investors must monitor closely. Looking ahead toward the coming quarters, the key battleground for ARM stock will be whether enterprise adoption in data centers can scale fast enough to offset any potential softness in consumer hardware units. If cloud providers continue expanding custom silicon programs built on ARM blueprints, royalty revenue could surpass consensus estimates and provide the fundamental support needed for shares to mount a sustained recovery back toward previous highs. On the other hand, if enterprise capital expenditure shifts away from general computing towards specialized accelerator hardware, ARM's growth trajectory could slow, leaving its high valuation multiple exposed to further adjustments. Investors utilizing an intelligent portfolio approach or managing self-directed trades across various investing sites must weigh these contrasting factors carefully. Whether you trade through Robinhood Investments, utilize Robinhood Cash Management and Robinhood Fractional Shares, or execute complex strategies via Interactive Brokers stock trading, success depends on analyzing the balance between market expectations and financial reality. Platforms offering SoFi robo-advisor services, SoFi ETFs, or SoFi stocks tools help automate diversification, but individual stock selections demand continuous scrutiny of underlying business fundamentals. For investors seeking investment help across multiple channels, whether comparing interactive brokers' account features, evaluating Fidelity trading platform analytics, or managing digital assets on Robinhood Crypto alongside traditional equities, the core lesson remains constant. Stock prices fluctuate based on the continuous recalibration between what the market expects a company to achieve and what its underlying operational performance actually delivers. In summary, ARM Holdings plc remains a premier technology licensor occupying a critical position in the global semiconductor landscape. Yet, as recent stock price movements demonstrate, even market leaders can experience sharp price contractions when investor expectations outstrip near-term financial reality. The contrast between enthusiastic retail narrative framing and disciplined